afternoon. My name is Kent Skornia, President and CEO of Krilogy. I'm here with my partner, John McArthur, our Chief Investment Officer here at Krilogy, and this is your September market perspective. We'll get right into it, Johnny. Kind of a wild few weeks here since you and I caught up. I guess really we caught up at the beginning of September. We did. We had some rate cuts. We've got stimulus going on in China. Obviously, we have an election going on. Even today, we've got, Israel conflict really ramping up, and there's some serious stuff going on around the globe. Tell us what's happening in your world, and what do you see in the markets right now?
A lot of market uncertainty, as you indicated, Kent. But here we are, near all-time highs in the S&P 500, almost on a daily basis. We've seen a pretty persistent uptrend. I think really it's interesting. It's almost a tale of two cities in a lot of ways with respect to the backdrop economically and markets-wise. I think you've got corporate profits near all-time highs. You've got GDP growth, most recently near 3% annually, which is quite stellar. You've got corporate credit spreads, which are really tame. And then you've got a lot of liquidity, in the system.
Yeah, $6.4 trillion sitting in money markets right now. The question is, now that interest rates are coming down, will that money market, will they move out of the money market, start to work into something more risk on in terms of the assets?
That's right. You've got most central banks cutting rates now, including our Fed, which has done 50 basis points so far. I think the interesting point is if you look at what the bond market is pricing in, there's at least 50 basis points more of cuts this year, 75 on the high end, and then another 100 basis points of cuts next year, which frankly, that's a recessionary type of pricing. So there's somewhat of a disconnect. And on, the other side of the coin, outside of those positives, there are your traditional recession indicators flashing yellow. We've had the uninversion of the yield curve, which has happened recently, and that has coincided oftentimes or preceded recessionary environments.
And we had that conversation early in the summer.
We did.
And we said, you never know when it predicts when the recession will come, but it definitely is an indicator of a recession coming.
Yeah.
And then all of a sudden the Fed drops interest rates, which is another indication eventually that a recession might come. You could argue that they've nailed the soft landing. Almost feathery, right? I mean, it's been that soft, and that we have landed. Now, what does it look like going into the future? Can we continue to have economic growth and lower inflation? But they're even saying, by the time of June next year, we could have interest rates in the threes.
Yeah.
I mean, that's a pretty substantial drop.
That's hard to fathom. You're right, though. That's what the bond market is pricing in.
Yeah, if you go 25 points each meeting between now and June, 6 more meetings, you're in the threes.
In a generally pretty vibrant economy, it's hard to see the capacity for that to happen. Even Fed Chairman Powell this week mentioned the continued data-dependent stance. I think the reality, the Fed is observing a softening labor market, and that's really key here. Typically, on a historical basis, once unemployment starts to rise, it moves. Yeah. And I think that's what the Fed is contemplating and observing. Even if we look at September data, consumer confidence plummeted. And so if the consumer, broadly speaking, is worried about being employed, the cutback in spending and therefore growth in the economy, and that's where things can really start to unwind. Again, that's not certainly a base case at this point, but that's in the periphery.
And let's talk about multiples. The S&P 500, we all know the Magnificent Seven, their multiples are in the 30s and even higher.
Right.
The other 493 stocks are closer to 18, and even then there's tech in the 493. You take the tech out of there, you're probably closer to 15, which is much more on a sort of a historical norm. It's not underpriced, but it's definitely not overpriced. And there has been some broadening in the market in terms of returns and all-time highs of A lot of other stocks beside the Magnificent Seven are hitting all-time highs. What are you seeing out there, at least in the S&P 500?
You're right. And, tech very quietly peaked around July 9th.
Yeah.
It's been a couple months, and we're definitely seeing a broadening out, to your point, and to past conversations that we've had. Last quarter, there were 325 companies in the S&P 500 alone that outperformed the S&P. That's been a trend we've not seen for quite some time.
Years.
Yeah, so you've got tech holding in there, but very quietly underperforming. You're seeing industrials. You're actually seeing defensives performing quite well, whether it's healthcare, utilities, staples, real estate. I mean, it's all very quietly done well. So the broadening out theme is an important one. I think what investors need to recognize in this environment, in particular as it relates to valuation, is, as we've talked about in the past as well, valuation is a very difficult and ineffective timing mechanism. We can go significantly higher from valuation perspective here, and what's ruling the day is liquidity. The global financial conditions are very pro-risk assets right now.
That's
Certainly, as central banks are cutting. In fact, financial conditions are looser now than they were when the Fed began hiking rates.
It's
It's hard to believe.
It is.
It's hard to believe, but it's the reality for now. So that doesn't mean that. It doesn't mean either or. It doesn't mean that from a valuation perspective things need to fall on their face. Although I would argue that it's more possible to have an accident of sorts. It's always kind of the risk that is unknown, right? We see geopolitical, we see a number of other things that are front and center, but when valuations are where they are, this market is ripe for a catalyst triggering event to cause some sort of reset that frankly can keep us still in a bull market, but it could be a 15 to 20% move to the downside.
And we typically have that once or twice a year, so it's not as if that would be a shock or surprise to someone like us who have lived through those things many times in our career.
Yeah.
The question about the risk on, risk off perspective is, if you have a lot of money sitting in money market, and interest rates are dropping dramatically. We all remember when interest rates were hardly at nothing and zero, and you really had to put money to work in more risk on assets in order to get some sort of return. But then how far do you go down on the risk curve? Right. Do you dividend, large cap dividend growth stocks? Do you go even to smaller caps because their PE is really low? Do you go international? Europe is low as well relative to the U.S.
Absolutely.
But then how far do you go on that risk curve? And I think that's the really important question when you're working with an advisor.
Absolutely. So it's what amount of that capital, if any, can go to equity risk, even if it's cash flow oriented equities. And at the minimum, it's the exploration into fixed income more broadly. Through this rate hiking cycle, there have been many dislocations within the bond market, and there are still attractive opportunities. Now, we've seen yields go down meaningfully, broadly speaking, which means prices have gone up. But that said, if we're truly worried about, or an investor is truly worried about economic risk and stability going forward, you're likely to get some pretty strong negative correlation benefits from being in more diverse fixed income than money markets, because even though the Fed's cut once, we're already seeing a decline in short rates.
Absolutely. So if you're in the bond market, you catch the yield, also catch some capital appreciation, which I know you and your bond team have been working really hard over the last few years and have done our clients well by that. So anything else to add to the conversation?
I think it's just a perfect time to assess risk in your overall portfolio. You always rather do that at market highs or close to it than, amidst a downturn when emotion is ruling the day. So just checking in how your portfolio positioning from a risk perspective aligns with long-term goals, I think is really important right now. And then if you can find different sources of return, look for low to non-correlated asset class exposures. Our team spends a lot of time and due diligence in that space, broadly speaking. And so, just being open-minded about where returns can come from going forward, I think is prudent.
I appreciate that advice because, we were just talking, are you a glass half full, glass half empty type of person? And in today's world, you can actually be both. And the reaction to that is just assess what's happening in your portfolio to give yourself a sense of what could potentially happen down the pike. So thank you very much, John. What a great conversation. And thank you to all of our clients. On behalf of Krilogy and its partnership, we appreciate the opportunity to be stewards of your wealth and wish you nothing but the best. For John McArthur, I'm Skornia. Have a wonderful day.